Welcome to Tech Money Madness, your daily U.S. stock market podcast. Today is August 26, 2026.
Good to be here.
Yeah, and it's quite a day to be diving into these market briefings. I mean, the stack we have today is just...
It's heavy.
It's really heavy, and there's this inescapable tension gripping Wall Street right now. Like, we were watching this sort of slow-motion collision, between these astronomical artificial intelligence spending numbers, sudden panic over the actual returns on those investments, and then this macro environment that, well, it kind of feels like it's being held together with duct tape.
It really does. It's a very precarious balancing act. And you can see that strain in the broader indices today.
Right.
Because the market is flashing this very nervous, kind of cautious optimism. So the NASDAQ 100, the QQQ, it's up slightly, about 0.77%.
Yeah.
But then you look at the S&P 500 and it's essentially flat. Microsoft is flat. Investors are just firmly holding their breath.
Yeah, they're waiting on, well, two massive things, right?
Yeah.
Nvidia's upcoming earnings report and the Jackson Hole Economics Symposium.
Right, which has the bond and currency markets totally on edge. But when you look past those headline numbers, the sources we're looking at for this deep dive, they reveal a market that is deeply conflicted about the physical reality of this whole AI boom.
Okay, let's unpack this. Because the immediate market movers today show a massive divide in how Wall Street is actually rewarding AI integration. We kind of have to start with the software side.
Yeah, the application layer.
Right, the company's actually selling AI tools to end users today. Like Salesforce. Salesforce is up 14% today.
Huge jump.
Massive. They absolutely crushed expectations, and it was fueled, almost entirely by AI growth and their gains from that Anthropic investment. You've got Mark Benioff, their CEO, out there saying they're delivering a dynamic interface that thinks, reasons, and acts.
And the market is just eating that narrative up.
They really are.
Because it represents a finished, monetizable product, They are seeing tangible tools being sold to enterprises today. And, well, the margins on software have historically just been incredibly attractive.
Oh, yeah. And it isn't just Salesforce either. OKTA, they surged 19% today.
19.
Wow. Their demand for AI-driven identity security is apparently just through the roof. They closed dozens of AI-related deals just in this quarter alone. And this is the stat that really jumped out at me. New products accounted for 30% of their total bookings.
30%. That's a massive adoption rate for new features.
Right. So the software side of the industry is basically having a parade right now.
They are.
But then we look across the aisle at Microsoft.
Right. The infrastructure side of the equation.
Yeah. Microsoft stock is completely flat today. And to be clear, their fiscal 2026 results are jaw-dropping.
Yeah, they are.
Net income is up 31%.
To $133.7 billion.
Right. And revenue's up 18% to $331.8 billion. Azure, their massive cloud platform, that grew 41%. They're sitting on a $678 billion backlog.
It's astronomical.
But despite generating numbers that look like the GDP of a small country, Microsoft's market cap has actually declined 4.5% year over year. Wall Street is looking at all that profit, and they're actively punishing them.
Yep.
And it's for this planned capital expenditure, this CapEx outlay of $175 billion for calendar 2026.
Right.
That's an 80% increase. It literally exceeds their operating income.
It's a staggering figure, and it's triggering this phenomenon known as valuation compression.
Okay, break that down for us.
Sure. So valuation compression happens when a company's underlying earnings go up, but its stock price stays flat or even declines. So essentially, the multiple that investors are willing to pay for every dollar of profit shrinks. They went from trading at 37 times earnings down to 27 times. Yeah. So what's fascinating here is that investors look at OKTA and Salesforce and say, we understand the software margins, you get a premium. But when they look at Microsoft, they're getting massive ROI anxiety.
Wait, I'm stuck on something here, though.
Okay.
If OKTA is booking 30% of their revenue from brand new AI products, why isn't Wall Street trusting that Microsoft's infrastructure spend will eventually, see those same returns? Isn't Microsoft basically just building the toll road for all this new AI traffic?
It's a really logical assumption to make, but think of it less like a simple toll road and, more like building a nationwide high-speed rail network.
Okay.
Microsoft is out there buying up the land, pouring the concrete, laying thousands of miles of track, building the power stations. That is incredibly capital-intensive. Wall Street is looking at that $175 billion and realizing it isn't going into the ether. It is going into highly illiquid physical infrastructure.
Data centers.
Data centers, cooling systems, power grids, silicon.
So it's like throwing a $175 billion wedding, and the guests are whispering about whether the marriage will actually last long enough to pay off the catering bill.
But that is exactly it.
And what happens if the demand for high-speed rail tickets, the software side of things, if that suddenly plateaus?
Well, that's the nightmare scenario keeping investors awake right now. If enterprise demand for AI software slows down even slightly, Microsoft is still on the hook for hundreds of billions in physical assets that, frankly, depreciate incredibly fast. So the market is suddenly terrified of the companies footing the bill to build the tracks, but they're thrilled with the people selling the train tickets.
Which brings up the actual material being used to build those tracks. I mean, if you're spending $175 billion on infrastructure, a massive chunk of that goes directly to hardware.
Absolutely.
And for the last few years, Nvidia has been the undisputed king of that space. Right now, they have a bullish sentiment score of plus 0.63 as everyone waits for their earnings report. But reading through these briefings, it's like a quiet rebellion brewing against their monopoly.
A rebellion born out of pure economic survival, honestly. Because when tech giants are spending $175 billion, they cannot afford to have their entire future dictated by a single supplier's profit margins. Nvidia's pricing power has been almost absolute.
Yeah.
And that's an unacceptable long-term risk for any trillion-dollar company.
We're seeing the proof of that pivot today, right? Because OpenAI just reportedly tested a custom chip codenamed Jalapeno.
Jalapeno, yeah.
And it actually outperformed NVIDIA's Blackwell systems on key inference efficiency tests. I mean, for a proprietary, custom-built chip to beat NVIDIA's flagship hardware, that's a massive signal. Are we looking at the beginning of the end of NVIDIA's absolute monopoly?
Well, I wouldn't call it the end of NVIDIA, but if we connect this to the bigger picture, it is the beginning of a massive structural pivot in how we build AI. Let's break down why that inference test actually matters so much.
Right.
In AI, you basically have training and you have inference. So training is like the model reading every single book in the library. It requires massive brute force computational power. Okay.
Inference is what happens later, when you ask the model a question and it generates an answer based on what it learned. So inference is the day-to-day work of AI. If OpenAI's Jalapeno chip is more efficient at inference, it means they can run their models for millions of users at a fraction of the cost, completely bypassing NVIDIA's architecture for their daily operations.
So OpenAI is trying to cut out the middleman by designing custom silicon tailored exactly to their own software.
Exact.
But there is a second path to breaking the hardware monopoly, and it's what Apple is doing. Honestly, I think it's brilliant.
It's very Apple.
It is. Apple has their September 9th event coming up. This is their first one under the new CEO, John Ternus. We're expecting new iPhones, watches, and IDC says their first folding phone could revitalize that entire foldable segment.
Right.
But the critical news for the AI space is the new Mac Studio they just launched.
The ones with the M5 Max and M5 Ultra chips? Exactly. These chips are specifically designed for heavy AI workloads right there on the physical device on your desk. Instead of building a $175 billion data center in the desert somewhere like Microsoft, Apple is putting the AI compute power directly onto your local machine.
It is the ultimate capital light strategy.
Yeah.
Because Apple doesn't have to foot the bill for the electricity or the cooling or the real estate of a massive data center. The consumer buys the hardware, they plug it into their own wall, and they pay for their own electricity.
And Wall Street is heavily rewarding that approach. Apple has a bullish sentiment of plus 0.57. Their net profit margin is an incredible 27.2%. They generated $110 billion in free cash flow.
Wow.
Which, for anyone not staring at balance sheets all day, that's the actual cash left over after a company pays for all its operating expenses and capital expenditures. It's the pure cash a business generates. And Greg Abel, the new CEO over at Berkshire Hathaway, just allocated 30% of their entire portfolio to Apple and Alphabet. Apple is winning by simply refusing to play the data center game.
They really are. And this creates a brutal environment for the companies caught in the middle. Because the economics of AI right now are forming this sort of barbell shape.
How do you mean?
Well, on one end, you have the hyperscalers like Microsoft spending hundreds of billions to build the massive centralized clouds. On the other end, you have Apple pushing the compute to the hyper-local edge on individual devices.
Yeah.
If you were stuck in the middle, you just get crushed.
And we see that in the broader AI space today, like Nebius Group. They swung to profitability with a massive 350% revenue growth. They figured out how to position themselves in this infrastructure race. But then look at SoundHound AI. They managed to double their revenue, but they are bleeding cash.
Oh, yeah.
They have a negative $103.1 million in free cash flow, and they're fighting off a class action lawsuit just to stay afloat.
It underscores how unforgiving the landscape is right now. You either have the capital to build custom silicon from scratch, or you have the scale to monetize the software immediately. Otherwise, you are suffocated by the sheer cost of the hardware required to even compete.
But, all of this custom silicon that OpenAI and Microsoft are building, it has to live somewhere. And right now, we are piling it all into these massive centralized data centers.
Right.
Look at Anthropic. They just signed a staggering $45 billion cloud deal to rent 460 megawatts of compute capacity from Nidscale in West Virginia.
Just picture the scale of that. That is a single facility drawing enough power for a medium-sized city dedicated entirely to artificial intelligence.
But when you put $1 trillion of global economic infrastructure under one roof in West Virginia, you don't just build a data center, you build a bullseye.
You centralize the vulnerability. That's the issue. As we transition the global economy onto this infrastructure, the attack surface for bad actors grows exponentially. We're moving away from distributed risk to these highly centralized points of failure.
And that fragility is breaking out into the open. Today, Boston Scientific, the medical device maker, they're hit by a cyber attack that completely disrupted their ability to ship products, sending their shares falling.
Yeah.
But it goes way higher than corporate disruption.
Oh, much higher.
Court documents just revealed that Chinese state-sponsored hackers targeted an absolute laundry list of critical U.S. institutions. We're talking about the Federal Reserve, NASA, the Department of Justice, telecommunications providers, power companies, and hospitals.
This is a coordinated, multi-front assault on the core nervous system of the country.
But here's where it gets really interesting. In the middle of all this cybersecurity chaos, OpenAI just released a 37-page report. And it's not a standard post-mortem where, like, an IT guy explains how a firewall failed.
Yeah.
It's a detailed report on what their own AI models did during evaluations before and during the Hugging Face AI agent hack. And just for anyone not living in the developer trenches, Hugging Face is basically the GitHub for machine learning. It's a massive central hub where developers share AI models and code.
Right. And the implications of that 37-page report are staggering. We're no longer just worrying about a human hacker stealing a password or deploying ransomware. We're literally reading breach reports about how artificial intelligence agents behaved autonomously during a cyber incident.
Pause on that for a second, because how exactly does an AI agent act autonomously during a hack? Like, are we saying the AI fought back or that it was manipulated?
Well, it can be both. And that is the terrifying reality of this new attack surface. As companies like OKTA and Salesforce successfully scale enterprise AI, as we integrate these dynamic interfaces that think, reason, and act into our daily workflows, those agents are given permissions.
Right, to do their jobs.
Exactly. Permissions to access databases, send emails, execute financial transactions. So if a state-sponsored actor breaches the network, they don't necessarily need to steal the data themselves. They can manipulate the autonomous agent into doing it for them.
Yeah.
Or, conversely, the agent might unpredictably attempt to just complete its assigned tasks while the system is actively being compromised, which creates total chaos. The more capable the AI becomes, the more devastating the exploitation of that AI can be.
And that brings a whole new level of anxiety to the macroeconomic environment. Because these tech companies aren't just fighting off state-sponsored hackers, they're being squeezed by economic pressures and regulatory roadblocks from the outside.
The macro tensions are almost as high as the technological ones right now.
Let's look at the broader economy. We mentioned the markets are cautiously positive today, QQQ up 0.77%, but the briefings describe the bond and currency markets as being completely on edge.
Yeah.
Everyone is staring down the barrel of the Jackson Hole Symposium, which is essentially the Super Bowl for central bankers, where the Federal Reserve signals its next big moves. But the weird thing is, the economic data itself is actually pretty good.
It is.
The Fed's preferred inflation gauge, core PCE, just came in cooler than expected at 3.3% annually. That's below the 3.6% forecast.
And core PCE strips out volatile things like food and energy to give us the true baseline of inflation. So a drop to 3.3% suggests the Fed is actually winning the fight against inflation.
Right. So what does this all mean? I mean, if inflation is cooling, why is the bond market in such a panic? Why are 8 in 10 economists surveyed basically demanding that Fed Chair Warsh provide clearer economic insights at Jackson Hole? Like, what is breaking the models here?
This raises an important question about what markets actually value, and right now, it comes down to policy uncertainty. Historically, bond markets fear inflation above all else. But right now, the anxiety isn't just about inflation, it's about unpredictable government interventions. We have Treasury Secretary Bessent implementing intervention strategies in the markets right now.
And how does a Treasury intervention actually impact, say, a bond investor?
Well, bond yields are priced based on mathematical models that predict organic economic growth and inflation. When the Treasury Secretary steps in to actively manage currency valuations or artificially pressure yields, the market is no longer free or organic.
Ah, I see.
The mathematical models just break. Investors can plan around 3.3% inflation. They cannot plan for a sudden discretionary policy shift from the Treasury. They feel like they're flying blind in a highly intervened market, which is exactly why they're desperately looking to Fed Chair Warsh to give them a reliable roadmap.
And that profound uncertainty at the macro level is bleeding into the regulatory and legal realities for these massive corporations, too. It kind of feels like the government is acting as a roadblock at every possible turn.
It really does.
Look at the media and tech space today. Meta just agreed to a $16.7 billion settlement with California and several other states over allegations regarding child mental health harms on their platforms.
Huge settlement.
Meanwhile, the massive Paramount Warner Bros. Discovery merger is completely stalled because of an antitrust lawsuit, leaving them in limbo during a crucial time for the media industry.
It just creates a paralyzing environment for corporate removers. When you're a tech CEO trying to plan a 5-year, $175 billion infrastructure build-out, you need regulatory stability. But right now, antitrust scrutiny is at a peak, and legal liabilities are in the tens of billions.
And it is all happening against the backdrop of a highly charged 2026 election cycle, which introduces even more systemic friction. To give you a sense of the legal maneuvering happening there, a federal judge just lifted the block on a Trump administration mail-in voting order. This order requires election officials to share voter information with the USPS and mandate the use of federally reviewed, uniquely barcoded ballot envelopes.
It's a massive logistical overhaul of the electoral process just months before an election.
And as a quick reminder to our listeners, we aren't taking any political sides here or endorsing any viewpoints from the source material. We're strictly looking at how these sweeping regulatory, legal, and electoral changes are injecting volatility into the landscape. But it proves your point. Whether it's tech platforms facing billion-dollar settlements, media mega-mergers being frozen, or nationwide election logistics being overhauled by a federal judge, the sheer amount of regulatory friction is immense.
And that friction acts as an anchor on exactly the kind of agile, rapid development that the tech sector relies on.
Right. Let's recap the top gainers really quick. We've got Okta up 19%, Salesforce up 14%. We mentioned Nvidia's bullish sentiment score of plus 0.63 heading into earnings, and Apple's bullish sentiment of plus 0.57, with analysts highlighting that 30% of Berkshire Hathaway's portfolio is now allocated to Apple and Alphabet.
Right. And if we look at the key themes from all this, it really boils down to 5 things.
Let's hear.
First, AI earnings are powering the market. We see Salesforce and Okta showing outsized gains from AI-driven results, while Microsoft's massive capex raises those ROI questions.
Yep.
Second, custom silicon is challenging Nvidia's dominance. OpenAI's Jalapeno chip signals a major industry shift toward proprietary hardware. Third, macro uncertainty ahead of Jackson Hole. Core PCE came in below expectations at 3.3%, but markets remain tense over Fed policy direction and Treasury Secretary Bessent's intervention strategies.
Definitely.
Fourth, cybersecurity threats are escalating. The Boston Scientific hack, Chinese state-sponsored hackers targeting critical institutions. And finally, tech valuations are under scrutiny. Investors are really reassessing whether enormous AI infrastructure spending will yield proportional returns.
Well, that's a lot to take in. And with NVIDIA's upcoming report and Jackson Hole setting the tone for the week ahead, it's going to be a wild ride. But, this brings our entire deep dive perfectly full circle.
It does.
We started today looking at Microsoft's massive $175 billion gamble and Salesforce's AI profit engine. But There's one final piece of news in this stack today that I think perfectly encapsulates the bizarre transitional moment we're living in. Amazon announced today that they are officially shutting down Mechanical Turk.
Wow. That really is the end of an era in tech.
For those who aren't familiar, Mechanical Turk was launched way back in 2005. It was this crowdsourcing platform where you could pay humans pennies to do microtasks that computers couldn't figure out yet, like identifying objects in a photo or transcribing a messy audio clip.
Right, right.
Jeff Bezos famously dubbed it artificial intelligence. From the outside, it looked like a sophisticated computer algorithm was doing the work.
Yeah.
But it was actually just thousands of underpaid humans sitting behind screens clicking buttons.
And the irony of that platform shutting down today, of all days, is almost poetic.
It really is.
Yeah.
I mean, think about the journey we have been on. On the exact same day that we officially bury Mechanical Turk, the platform where humans had to pretend to be software, we are reading a 37-page report from OpenAI detailing how actual AI models acted autonomously while being targeted by foreign governments in a massive cyber hack.
Yeah.
We have spent hundreds of billions of dollars to evolve from humans pretending to be AI to AI acting completely on its own.
And acting on its own within the most critical, centralized infrastructure we've ever built. That $175 billion Microsoft is spending isn't just buying chips and pouring concrete for data centers. It is building a new, incredibly powerful and highly targeted nervous system for the global economy.
It really leaves you with a profound question to chew on as you watch these markets. When the novelty of these AI tools finally wears off, when the $175 billion data centers are fully built, and this massive digital infrastructure is just humming quietly in the background of our lives, who is actually going to be in control of it?
That is the multi-trillion-dollar question that every investor, and honestly every citizen, should be asking right now.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.